Hello, and thank you for checking out today's independent annuity review, courtesy of AnnuityGator.com. Today we'll be taking a close look at the Prudential Defined Income Variable Annuity, and this is one of the first variable annuities that we've reviewed here on AnnuityGator. The first few that were posted in 2013 were all fixed index annuities with lifetime income riders or guaranteed lifetime withdrawal benefits, depending on the verbiage that you prefer. Before we dig in, a few legal disclaimers should make sure we spend a minute on. This is a review. It's not a recommendation to buy or sell an annuity. Prudential Financial has not endorsed this review in any way, nor do I receive any compensation for this review. This review is meant to be an independent review at the request of website visitors so they can see the Annuity Gator perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have specific questions as they relate to your individual circumstances. All names, marks, and materials used in this review are property of their respective owners and not that of AnnuityGator.com. Now, while care has been made to ensure this review is complete and accurate, no warranties are made to the completeness or accuracy. Since this is a variable annuity, this is a little bit different than fixed annuities. It does have some guarantees based on the claims paying ability of the issuer, but it should also be noted this is not FDIC insured. There's no bank guarantee. It's not insured by any state or federal agency. It may lose value, including the loss of invested principal. And those, by the way, are true of all annuity products. All right, let's dig in. So this particular annuity, some key facts. It's issued by Prudential Financial, a very large financial institution. It's rated AA-, which is a very strong rating by Standard & Poor's. This is a variable annuity with a defined income guarantee. So for those who don't understand the difference between variable annuities and fixed annuities, this variable annuity has a component that's attached to a sub-account. A sub-account looks a lot like a mutual fund, but it is different. What that means is that the actual value, which I always refer to as the liquidation value or sort of the true cash value, it goes up and down, and depending on if you choose to liquidate the account or liquidate the annuity, it may be worth less than what you paid for. The value can actually go down when looking at just the cash value of the account. The difference, of course, in a fixed annuity is that outside of surrender penalties, a fixed annuity's principal value is guaranteed. So as long as you hold it past the surrender schedule, you're guaranteed not to lose your principal. That's not true with this, because if the sub-accounts go down in value, even if you satisfy your surrender schedule, it could be worth less than what you put money in. So that's kind of the big difference between a variable annuity and a fixed annuity. This does have that defined income guarantee, which means that the income part of this annuity, so it has a feature that'll pay a guaranteed income for life based on the claims paying ability of the issuer. That component is guaranteed. So that's similar to a lot of the guaranteed lifetime withdrawal benefits that have been attached to a lot of fixed annuities or fixed index annuities in recent years. This particular annuity has a single investment option, which makes it a lot different than most variable annuities. A lot of variable annuities will have 20 or 50 or even hundreds of different investment options that you might choose. This particular annuity has a single investment option. It's called the AST Long Duration Bond Portfolio. And I'll explain why that is the case in a nutshell. It's because the defined income guarantee, so the minimum lifetime income benefit from this annuity, is higher than most other variable annuities. As such, it has less investment options. What this does is it helps limit the amount of risk that Prudential's taking by issuing it. Because they don't allow stock investments, there's less risk that you'll lose your principal and then leave them kind of on the hook for just the principal or the income guarantee. So we'll dig into a little bit kind of what this means in a moment. Some key features and costs on this annuity. Since this is a variable annuity, it has a little bit more disclosed costs than fixed annuities. A lot of the fixed or fixed index annuities, they are pretty, I don't know what the right term is, but they hide their costs pretty well, I guess is maybe a good way of putting it. Whereas with a variable annuity, Whether you like their fees or not, at least they're fairly disclosed. If you just take a look at their prospectus, you'll find these are their current costs as of May 28, 2013. Has basically, there's really 4 total costs, but there's 3 main costs of the chassis. These are the fees that are collected by Prudential. There's the mortality and expense charge, often referred to as M&E. That's 0.95% per year. It has an administration charge. That's 0.15% a year. And then because it has this defined income benefit, which is always included, by the way, some variable annuities allow you to add or subtract different features or riders. This always comes with the defined income benefit, and that rider, or that charge, I guess I should call it, since it's not really an add-on, it's just part of the product, is 0.8%. In addition to these fees, you also have the cost of the AST long duration bond portfolio, which I'll get into in a minute what that is. All of these fees are what they are today, but the fees can change. So in theory, they could go lower or they could go higher. If you read the prospectus, you'll find what the maximum charges are. The only reason why the fees might go up is if the cost of the guarantees is too high, and in order to stay viable, Prudential needs to charge a little bit more in order to ensure that the benefits are able to be paid out. It also can change the guarantee. So based on the day that you purchase it, you'll want to make sure you check. Obviously, all the math used in today's review is based on today's rates. Those numbers can change. So you just want to make sure you take a close look before you pull the trigger on this or any investment. Best way I find to show people how these annuities really work is to use Microsoft Excel and just illustrate them. So I've built a couple spreadsheets, in this case one very specific spreadsheet that helps test that defined income rider or defined income benefit. This is particularly important because a lot of people who sell annuities, they don't really tell you what your real returns are. Instead, they use things like what your roll-up rate is or your distribution rate. Those numbers are usually quite a bit higher. Maybe while you're not using it, it grows at 5.5%, and then when you go to take income, you'll get 5%. But in reality, unless you live a very long time, you'll never really make 5 or 5.5%. Your true earnings will be less than that. So what I'm going to do now is close down this. This is a PowerPoint that we're looking at the moment. I'm going to pull up an Excel document. We're going to stress test the rider so you can see in an actual example how this might play out for a potential investor. All right, I'll be right back. Okay, so now we have a Microsoft Excel document open, and the purpose of this is to help illustrate the defined income benefit of the Prudential defined income variable annuity. So in essential, a basic way to describe how this works is while you're not using it, it will grow an income base. Okay, so what you can see here is I put together a column that illustrates the income base. The income base right now has a growth rate of 5.5%. So each year that you do not touch the money in the annuity, the income base will grow by 5.5%. When you go to take income, you then will have income based on a distribution rate. The distribution rate is going to be based on your age. So as you can see here, when someone's 55 years old, if it's a jointly owned, so I kind of put a toggle switch in here, I can switch it between a single or a joint. So if someone's single and they're 55, the distribution rate is 4%. If they're 65, it's 5%. What you'll notice is that the distribution rate goes up by 0.1% per year. So the longer that you wait to take income, the larger the percentage of your distribution is relative to your income base. What happens is that'll calculate out to a income that's then guaranteed for life. So this illustration I put together here is just a very hypothetical, simple illustration of where someone might use this. And what you can see is we start this with, in this example, a single person who's 55 years old. They start with $100,000, just again a simple round number. And each year that they don't touch the annuity, the income base rolls up, so it gets larger. In this example, they wait until they're 65 and then they go to take income. That 100,000 then grows to 18209.24, and then from that income base they get to take distribution. Distribution is going to be 5% of that income base, creating a income for life guarantee of $9,010.46. Now, if I toggle this back to a joint owner, the numbers change a little bit. What happens is the insurance company, of course, if they have to guarantee payments for two people's lives, they're not going to guarantee quite as much income because the odds are one of those two people will live longer than if it was one person by themselves. So in this case here, if it's a joint, it's going to pay 4.5% at age 65 versus when it was single, it paid 5%. The income base grows at the same rate regardless if it's a single owner or a joint owner. So in both cases, that income base is compounding at 5.5% per year. So let's take a look at this under the joint case, and I'll switch back and we'll look at the numbers using a single life example. So what happens is I created a column that says cumulative income, and the cumulative income is essentially what gets paid back to the annuity owner once they elect to receive the income for life. Because it's, in this example, $8,109.42 because it's a joint owner, so it's a couple. They're both 55 when they start, wait till they're 65 when they begin income. What we notice is that each year, that income, the cumulative income, is growing by $8,109.42 per year. The next column I created was to calculate the investment gain. And what you'll see here is it's all blank in the initial years. And the reason is that until you actually get paid back what you originally put in, you haven't actually made an investment gain. So the rider doesn't really produce a benefit until you've gotten, at least in this example, $100,000 back. After you've received at least $100,000 back, then you start making an actual investment gain. So you'll see the investment gain in this example kicks in at age 77, so 22 years after it started. At that point, the investor has now gotten back more than they put in this case, $5,422.41 more than they put in, which then, if we keep following the columns over, I calculated what the average annualized return would be. So if you earned 0.44% per year over the course of 22 years, that would produce that same amount of investment gain. Just to make it easier, you shouldn't have to look back from the right side over the left and calculate the difference from start age to current age. I did add a column on the far right that says number of years, just so it's easy to see how many years you have to wait to earn a certain investment return. Now, with all products like this, the longer you live, the larger your investment return will be because it takes quite a while to break even. The reason I think this is really important is because if a financial advisor is not being entirely honest, they like to illustrate or explain sometimes that the earnings are the income growth rate, which grows this income base. In this case, it's 5.5% a year. And they like to use the distribution rate. So a common thing someone might say is, while you don't touch your money, it's guaranteed to grow at 5.5% a year. When you do decide to take income, you'll get income at 4.5% a year. Now, those would be true statements, but it doesn't really tell you what your earnings are. It's just telling you how your income is calculated. And while I think that it's fair to use that type of a description, I think it's also fair that people understand what that really means. In other words, what do you really earn? What kind of earnings are you really making on your money? In this case, we only know that by calculating these numbers over here, your investment gain and what that is in a corresponding return. And you can only do that after you've gotten paid back what you've put in. There's a saying I use a lot, it's that you don't make a return on your investment until you get a return of your investment. So here, that's exactly what we're calculating. I think it's also important to have these year columns because if someone came to you today and said, hey, I've got this great investment that over the next 25 years will pay you 1.94% per year, a lot of people wouldn't be particularly interested. Now, that's not really a fair comparison to make to this annuity because this has an income for life guarantee, whereas if something just was a 25-year maturity, it wouldn't have that. It would just pay 1.94% over 25 years. In this case, that becomes, again, your annualized return, but if you live a really long life, you'll just keep making more and more and more. Now, I ran this all the way out to age 95, so if I scroll down just a touch so you can see it, you'll see that if we go all the way out to age 95, an investor would have received back $251,000, which would be a $151,000 gain, which would be 4.31%. It would take them 40 years to earn that much a return. I did this really for a couple reasons. One is there's always a chance you'll live a very long life. That's a good reason to use an annuity, kind of longevity risk. If you live too long, you don't want to run out of income. And products like this, they do give you a baseline income that you cannot outlive. That should be the main reason people look at annuities like this or anything that has an income for life guarantee. The best way to kind of measure one product versus another is to look under your individual circumstances, run a test just like this one to find out which annuity really makes the most sense, if one makes sense at all. Really, the only way to know if they make sense at all is to have a pretty detailed financial plans specifically built around retirement income planning to figure out, will this help you reach your long-term goals? One of the things that certain annuities, if they don't have an inflation adjustment, so if this just pays that $8,100 per year from age 65 till as long as you live, that's nice, except for in 30 or 40 years, $8,100 might feel more like $3,500 in today's buying power. So we have to be careful to make sure that, again, you test these annuities within a bigger picture financial plan to make sure that it fits in with all of your other assets and income. At the end of the day, the returns on this are actually not too bad when compared to other income annuities. What some people might find is that when looking at different income annuities and you talk to different supposed retirement income planning experts or financial advisors for retirement, people like that, the numbers they tell you are not oftentimes the real numbers. They use, again, the numbers like the income account growth rate or roll-up rates, and then distribution rates, but they don't actually calculate, like we do here, what that really means in terms of annualized return. Until you actually calculate what the annualized return for your situation, it's hard to really know which, if any, annuity is best or right for you. So never just take someone's word for it. Make sure that you have all of them tested and make sure that you get really the best deal. What might be the best deal for one person could not be the best deal for another person. Really is as simple as that. If it sounds too good to be true, it usually is. So you always have to do your homework and due diligence, run the numbers like this to figure out if it actually makes sense. So if we just want to kind of look at this over, let's say, a 30-year time period, if someone thinks they'll live till age 85, we can see that the annualized return is 3.31%. They live 35 years out to age 90, it's 3.99. And as mentioned earlier, if they live to age 95, 40 years from start date, it's 4.31%. I think it's safe to say that most people who use an annuity like this will probably average a return somewhere between 1.5% and 4.5%. With probably a median return somewhere in the low to mid 3% range. It's not terrible since it is guaranteed, but it's certainly not as great as some people might think it is. The numbers work a little bit better if we toggle this back to a single person. If it's a single person and they live a long time, their numbers can be a little bit higher. But again, keep in mind that the odds are lower that a single person is going to live as long as two people who are the same age. If we look at it from that perspective, single person using the same ranges, they go 25 years from start date, from age 55 to age 80 before they pass. They'd be looking at 2.73%. If they have 30 years out to age 85, they're looking at 3.97. If they live 35 years out to age 90, it's 4.55. If they live 40 years out to age 95, it's 4.81. So again, the average is going to be somewhere probably between the low 2s and the high 4s, with a median somewhere around 3.8 to 4.25. That's, again, statistically the most likely end result for those folks. All right, so now you've seen how the income works on this. This is the real big reason why, if someone's going to consider this annuity, why they would consider it. I can tell you that there are other income-based annuities that do have higher annualized returns than this, so it's not the best game in town in that respect. So we hope that the other benefits of this annuity might make it better. In this case, because it's a variable annuity, in theory, it should have a better return potential than a lot of the fixed annuity or fixed index annuity counterparts that also have income guarantees attached to them. But it is a little bit limiting because this has only one investment option, which is the AST long duration bond portfolio. So I'm going to close down this particular Excel document. We're going to move back to my PowerPoint, and I'll show you a little bit more about the AST long duration bond portfolio and perhaps what some reasonable expectations might be there. So you'll really be able to see the two moving parts, the part that's attached to the bond market, which may produce a better result than what you see on a guaranteed basis, and then we'll just sort of recap these guaranteed returns. You can kind of see the two different features side by side, and I'll do a little closing and I'll tell you where this would work best for somebody and where it would work worst, and kind of recap the positives and the negatives. So hope this was beneficial. I'll close this down and be back via the PowerPoint here in just a moment. All right, so we are back on the PowerPoint, and what I'm going to do now is just kind of walk through some recaps on this particular annuity and give you some best and worst case scenarios and show you where it works best, where it works worse, and also show you a couple resources that'll help you see where I came up with some of my numbers in the recap section. All right. So here's the long-term stress test summary. As I mentioned, there's two kind of moving parts to this. There's the actual liquidation value, which is really attached to a single sub-account, the AST long-duration bond portfolio. And then there is the defined income rider, which I just illustrated a moment ago. In this case, on the left-hand side, it's a little bit difficult to illustrate. I'm not going to try to make any excuses, but in a nutshell, the AST long-duration bond portfolio doesn't have any real history, so it's difficult to look at it and try to figure out what it will do in the future. So instead we had to turn to the previous history of bonds in general and try to come up with what is reasonable to expect from the bond market as a whole. Now hopefully the folks that are managing the AST long-duration bond portfolio produce really, really exceptional results, and they beat the pants off the bond market averages and produce better results for annuity holders. But we don't know if that's the case. They might do worse than the averages of the bond market. Historically, it's been difficult for active mutual fund managers to outperform the broad market indexes, which is one of the reasons why index funds have become so popular in the last 20 years. So on the left-hand side, what it is, I showed a couple different statistics. What you'll see is it says average annual return of bonds before fees. That's just the broad average of bonds looking at 1928 to 2010. So we're looking at, in that case, about 72 years of bond market history. Bonds have averaged 5.28%. Now that's before fees. In this particular annuity, the fees are pretty high, 2.73% per year when you add up the variable annuity chassis charges and the fees of the actual long-duration bond portfolio. So if we look at the average annual fees return net of that, if we just assume all things being equal, it would take that 5.28 and drop it down to 2.55. Now this may or may not be accurate, as I've just kind of disclosed. I just think it's fair for people to try to get some type of idea of what their upside is if they don't end up using the defined income rider or the income benefit, so to speak. Now if you're wondering where I got that number from, in the bottom left you'll see the source. According to US News, they wrote a post. I put the full link into it there, so if you jot that down and scroll on over to the URL, you'll see the report for yourself. It shows what the long-term returns are. There's also a couple of other interesting spots that you can find. I did a little search. Just if you type into Google long-term average of bonds, you'll find a bunch of different articles. I found one that was pretty interesting. I didn't post the link here, but thought I'd share, and it came from Charles Schwab. According to Charles Schwab Investment Advisory, they are not expecting bonds to produce as good of returns the next 30 years as they have the last 30 or the last 50 or in this case the last 72. They're expecting returns really to be closer to 3% before fees, and their logic behind that is simply that today interest rates are as low as they've ever been. So if you buy a bond portfolio today and interest rates stay low, your yield is simply going to be very, very low, much lower than 5.28%. If interest rates start to rise and you own long-term bonds, interest rates and bond prices move inversely of one another, which means that if interest rates go up, bond prices go down. Now they do end up yielding more, so eventually over the long term, your returns start to equalize, but it does take a while for that to happen. And there's no guarantee that interest rates will go up substantially in the future. I think a lot of people, myself included, would think they will, but we do not know that for sure. All we know is if you go out and buy a 30-year bond today, it's not paying 5.3%. It's probably paying more like 3.3%. So we have to be a little bit careful when looking at what to expect from the bond portfolio component of this annuity. Since that part's the variable part, we can then focus more on, well, what's our worst case scenario? In this case, the worst case scenario is what you see on the right-hand side. That's the defined income rider. In this case, I just did one summary showing the joint numbers that we used in our Excel document. In that case, we used a starting example of age 55. So imagine a couple, both age 55 when they start. They wait 10 years to take income at age 65. And then if they live 30 years total, so to age 85 from their start date, their average annualized return would be 3.31%. My personal opinion, though again, there's no actual way to illustrate factually exactly what will happen because again, this is a variable annuity. Nobody knows exactly what will happen. But I do think that the returns of the defined income benefit are probably going to be pretty close to what the returns are from the long duration bond portfolio. The returns probably will end up being somewhere, for most people, if they live long enough anyway, somewhere between the low 2s and maybe the low to mid 4s, with an average right around that number you see on the right-hand side, 3.31%. If you happen to have a lot of longevity in your family and maybe you live till you're 100 or 105 or 110, which I think there'll be more and more people doing in the future, the returns, of course, will be higher. The longer you live, the better the returns are. If you don't live so long, or if your family doesn't have a lot of longevity, or if you already have health problems and you know that your life expectancy is not going to be longer than average, then this is not going to produce a particularly high return, though again, the defined income benefit is guaranteed based on the claims paying ability of Prudential, so it is pretty safe. All right, so here's the positives. The real pros on this particular annuity is that it provides an income for life guarantee. If that's what you're seeking, then this annuity could be a fit. Just depends on if this is the best one for your situation. That'll all depend on how old you are, how long you plan to wait until you take income, and then you have to just kind of compare it, shop around, compare it to all the other options that you have, and see if this one fits. Part of that comparison is based on the second bullet point here. This is a very highly rated issuer, so Prudential is a solid company. They use the analogy that they're like a rock. They're stable, been around for a very long time. So there might be maybe another company or two that say they pay more, but their rating is not so good. They don't have the same type of reputation. That should all play into people's considerations on what annuity is right for them. But the best things I can find about this annuity are these two items, that it has an income for life guarantee based on Prudential's claims paying ability, and Prudential is a highly rated issuer. The cons is that this won't end up being the highest paying income rider for most people. There are other types of products that have income benefits that, in most circumstances I've tested, are going to be quite a bit higher than this. The other thing that I'm not a big fan of is the limited upside and only a single investment option. That's that AST long duration bond portfolio. Because of this, unless bonds produce really good results in the future, really what you're getting here is just the income for life guarantee, but having some upside, though it be limited, by having a bond portfolio as sort of your backing. The limited upside is really compounded by the third bullet point here, which is the high costs. If this was much cheaper, then I actually would think this is pretty good, because the truth is a lot of the annuities that'll pay a higher amount on the income guarantee are fixed index annuities. And those fixed index annuities, based on their current caps and fees and crediting methods, most of those will not perform as well as a simple bond portfolio. So in reality, just having a bond portfolio is, in many cases, better than an actual index annuity. The issue is that in this case, it costs quite a bit of money, and interest rates are so low it's hard to know what to expect from bonds looking into the future, the next 10, 15, 20 years and beyond. So I'm not a huge fan because of the cost, but again, structurally, it's not like this is a bad product. It's actually going to be very competitive with most of the fixed index annuities, and on a guaranteed basis, it's much more competitive than most of its variable annuity competitors. So here we go. I hope you enjoyed today's review. Maybe you have questions, need a little feedback. If you need some help, always feel free to reach out. If you have some general questions or want to run your scenario by and ask for some direction, we're happy to do that. There's a couple different ways that you can go about getting help on this annuity or just retirement income planning or annuities in general. One is you can always shoot an email to Gator, G-A-T-O-R, at annuitygator.com. Or on the website, you'll see in the top right-hand corner, there's a tab that says Free Annuity Help. If you click on that, it'll take you to a secure form where you can fill that out. And in that example, an email will get sent off to myself and the Annuity Gator team. Whenever we get a message, we always try to respond within 24 hours. All we do is we try to get back within 24 hours and help point you in the right direction. We're happy to be of help. It's truly a great way for people just to get some unbiased feedback and help make sure you don't make a bad decision today that you'll regret later on down the road. Again, thank you for checking out today's review. Remember to keep coming back to AnnuityGator.com anytime you want to see future reviews. Maybe you have another product you'd like us to take a look at. You'll see that there's a tab on our site that says Annuity Review Database, I believe, or it might just say Annuity Reviews. If you go into that place, you can actually suggest an annuity you'd like to have us take a look at. Can't guarantee how soon. It does actually take a lot of work to produce these, so sometimes it takes a week or 2 or 3. But we only know which ones people want to know more about if you reach out and let us know. So feel free to suggest any annuity that you might be considering, and we can give you some independent feedback, run the stress tests like we did in this video today, so you have a better idea of if that particular annuity is right for you. Have a wonderful day. Best of luck in whatever it is that you're doing, financially speaking. And if you, again, have questions, always feel welcome to reach out. We're happy to be of service. Have a great day.